Hey everyone, and welcome to The Explainer. I am so thrilled you're here today because we're going to look way past the shiny, incredibly loud headlines of the everyday stock market to uncover a massive financial shift that is happening right under our noses. Every single day we're completely bombarded with news about the latest tech boom and record-breaking stock indexes, right? But beneath that very calm, very optimistic surface, a profound realignment of global wealth is taking place. Today we're breaking down exactly what the data is telling us about this underlying tremor. And trust me, you are absolutely going to want to see how these pieces fit together.
Okay, let's dive into this. While retail investors and the broader financial media remain laser-focused on technology stocks and artificial intelligence, there's a much larger, much quieter story unfolding in the background. The smart money, the massive institutions and nations that look decades ahead, not just to the next quarter, they aren't just obsessing over semiconductors. They're actively positioning themselves for a reality that the broader market is currently completely ignoring: the mounting, silent stress in the global bond market. The current market environment is literally perfectly captured by that classic fairy tale. Right now, almost everyone is bowing down, cheering for the stock market, saying everything looks fantastic as indexes hit new all-time highs. But beneath that perfectly tailored suit of tech gains, we have the terrifying naked truth of a brewing government bond crisis. Eventually, the realization hits, the truth is acknowledged, and panic ensues, simply because the underlying fundamentals do not support this current level of blind optimism. Section 1. The Silent Bond Crisis. Let's take a look at the first major hidden crack in our financial foundation: sovereign debt.
So the crucial point is this staggering figure right here, 8.23%. That is the percentage by which the total outstanding United States government debt has risen in just the last 12 months alone. Think about what that actually means in the real world. The government is rapidly expanding its debt, essentially making the currency itself poorer year over year. And as all that new money enters the system, whoever gets their hands on it first isn't just buying groceries. They're pushing up the prices of finite assets. We're talking everything from technology stocks to luxury real estate and, crucially, monetary metals. We are witnessing a rapid, systemic evaporation of purchasing power.
But the rising total debt is really only half the story. The true crisis here is the interest rate burden. Over the last 10 to 15 years, governments gorged on massive amounts of debt at near zero interest rates, paying maybe 1 or 1.5% on long-term bonds. But those older, cheap bonds, they're maturing right now. And as they mature, they have to be rolled over and replaced with new debt at today's rates, which are sitting much closer to 4.5%. It's like a teaser rate on a credit card suddenly expiring. This is creating an incredibly rapid, unsustainable rise in the government's interest burden, a mathematical reality that even the Congressional Budget Office's long-term forecasts clearly show.
Section 2. Central banks making moves. Let's shift gears and see how nations around the globe are reacting to this unfolding bond crisis by aggressively tweaking their reserve strategies.
And this brilliantly illustrates the historical irony of how governments panic during a currency crisis. Just consider the infamous brown bottom of the 1980s. That was when Gordon Brown sold off Britain's gold reserves at rock-bottom prices like around $200 to $300 an ounce, desperately trying to prop up a plunging British pound. Fast forward to today, and we see Turkey doing the exact same thing to fight off massive inflation of 35% or more. They've been liquidating gold reserves at much higher current prices just to plug holes in their weakening fiat currency. They're treating the symptoms, essentially putting out a fiat fire by throwing their most pristine asset right into it.
But while countries like Turkey are panic selling to save their currency today, other nations are taking the exact opposite approach. Non-Western central banks, with China really leading the charge, are aggressively increasing their physical gold reserves, and they are doing this relentlessly. They're adding massive volumes of ounces to their vaults despite the higher prices. They're making a calculated strategic decision to reduce their exposure to foreign debt instruments, particularly U.S. Treasuries, and choosing instead an asset that carries zero counterparty risk and simply cannot be printed out of thin air. Now, you might hear about the soaring price of gold and think, wait, isn't this just another speculative bubble? Well, this number right here shatters that myth completely. Right now, gold makes up less than 1% of discretionary institutional portfolios globally. Historically, a real bubble requires widespread participation, right? A bubble happens when absolutely everyone owns the asset and optimism is totally universal. At less than 1% ownership across the board, precious metals are wildly underowned. The price might be climbing, but institutional participation is barely even off the starting line. Section 3. The Financial Sector Warning. Let's guide our focus back to the domestic stock market to look at a pretty terrifying indicator flashing right beneath the S&P 500's record highs.
To analyze this properly, we really need to use a specific tool called a spread chart. Now, a spread chart is incredibly simple but wildly powerful. It just divides the price of one asset by the price of another. We do this to completely strip away the noise of the broader market just drifting upward, which helps us reveal the true relative performance of a specific sector over time. Today, we're going to use a spread chart to look at the XLF, that's the broad financial sector ETF that includes banks, broker-dealers, and insurance companies, relative to the S&P 500.
Let's walk through the historical precedent first, kind of set the stage. Back in 2006, the financial sector basically just went sideways. But then in September and October of 2007, something absolutely critical happened. The S&P 500 was popping to all-time new highs, and everybody was popping champagne and celebrating. But the XLF didn't make a new high. In fact, the spread chart of the financials versus the S&P broke down through a massive floor. The financial sector quietly puked, sending a glaring warning to the very few people paying attention a full 6 to 9 months before the massive 2008 financial crash actually brought the whole house down.
Now, what's really interesting about this slide is that history appears to be rhyming right now, but in a highly exaggerated way. Over the last 5 or 6 years, the XLF spread basically went sideways. But recently, that spread between the financial sector and the broader S&P 500 just blew out to a multi-decade low. Exactly like in 2007, the financial sector is currently puking and flashing a massive warning sign. It is significantly underperforming while the broader market is just being propped up by a handful of tech stocks. The financial sector is the crucial leader that nobody is looking at, and when it starts to crack like this, it generally signals deep underlying stress in the system.
Section 4. Rethinking your portfolio. So let's shift focus to the actionable takeaway here. What should an everyday investor actually do given these underlying macroeconomic tremors?
For decades, the absolute standard gold star advice for investors was the classic 60-40 rule. 60% allocated to stocks for growth, perfectly balanced by 40% in government bonds for safety and yield. This was the old orthodoxy. And hey, it worked beautifully during an era of falling interest rates and abundant liquidity. But as we've just seen, the bond market is now a source of significant risk, not a safe haven.
Which brings us to a rather shocking acknowledgement of our new reality. Recently, the chief investment officer of Morgan Stanley came out and suggested that the old 60-40 rule is basically dead. Instead, he suggested a radical adjustment. Keep 60% in stocks, but slash bonds down to only 20% and move a full 20% into gold. I mean, having a major mainstream institutional voice suggests slashing bond exposure in half to allocate 20% to a monetary metal, that is a massive revelation. It's a crystal clear signal that the financial establishment is finally beginning to recognize the need for strategic financial insurance against these sovereign debt risks.
Let's move to the next concept and see how this builds, because this rotation out of monetary excess is spilling over into all tangible, raw commodities. It's not just a gold story. Silver is seeing massive attention because it has dual demand. Sure, it's a monetary metal, but it's also highly critical for solar energy and electronics. Copper prices are surging due to massive global infrastructure and electrification projects. And if you just look at the XME, the base metal miners ETF, it has absolutely exploded relative to the stock market over the last couple of years. The smart money is clearly moving into real, tangible assets that can withstand fiscal uncertainty and inflation.
We've covered a ton of ground today, right? From the silent evaporation of purchasing power through sovereign debt, to the strategic accumulation of physical assets by global powers, all the way down to the stark warning signals flashing in our own financial sector. This great wealth shift is actively moving capital away from paper promises and straight into tangible realities. So I want to leave you with this one highly provocative thought to chew on. When the broader market finally stops staring at AI, and the little boy points out that the bond market emperor literally has no clothes, where will your wealth be? Thanks so much for joining me for this explainer, and I can't wait to explore our next topic with you soon.